know the software very well. Worked with Len all these years developing many of the things in it. Of course, before I start, I will just say that this is educational. I'm not going to suggest any trades that you should run out and do. And of course, options involve risk. I'm not going to go any farther into that. What I am going to talk about is start talking about earnings announcements. Earnings announcements have always been an exciting thing to trade. People have been doing it, of course, for decades, whether they're just simply buying or selling the stock based on what they expect the earnings to do, or using options. Of course, with earnings, it can be tricky because first you have to think about what is going to happen. You think that they're going to have exceptionally good earnings or bad earnings, and you have all those analysts that are giving their estimates on earnings. And then once they announce earnings, people will check them against the earnings that people expected. But sometimes it's not a linear type of relationship. People could expect good earnings, they could give you good earnings, and then all of a sudden the stock plummets. Many times it's not simply the earnings, but they'll also look at things such as whatever else they're saying. They may say, oh yeah, earnings were good this quarter, but we expect things to slow down over the next year and earnings to be worse in the future. So even though this particular earnings was good and you were right that they were good, you end up being wrong on the trade because of other information that comes out that causes it to move in the opposite direction than you would expect. Once you get into options, it becomes even a little more tricky because of how options are priced. I mean, everyone knows, the market makers know, everyone in the market knows, these guys are about to announce earnings. And they say, well, lots of times when you announce earnings, the stock goes crazy. It could jump quite a bit. It could drop quite a bit. So they price the options expensively, those that are going to be affected by the earnings. And that causes it even harder to decide what's a good trade. If you buy a call because you expect earnings to go up and the stock jumps up, the volatility drops once the unexpected or the earnings announcements out of the way. The amount that drops could overwhelm the amount that you make from the price of the stock going up, and you end up losing money. So that's where OptionVue comes in, and OptionVue uniquely of any trading platform I know of incorporates earnings announcements. It knows when the stock is going to announce earnings, and then it models this slowly rising volatility leading up to the earnings announcement, and then the vol crush that occurs afterwards. And I'm going to go through this in OptionVue itself, showing you the volatility and what happens. But first I'll just tell you, first of all, the earnings announcement dates and this kind of modeling, it's just built into the OptionVue software. We have a lot of features based around earnings just built into the software that's included in every OptionVue subscription. We do have a special earnings play that actually recommends trades in a few different categories, and I'll just mention that at the end. But most of what I'll be talking about is just built into the software. One of the key things, of course, is to make sure that the earnings dates are accurate. That can be really tricky because you might want to start watching them a while in advance. At first, most of the earnings, like if you go out to Yahoo, NASDAQ, almost any earnings site, they're first going to give you an estimated time. Expect them to announce earnings, about April 28th. But then somewhere in a week or two before the earnings announcement, the company actually puts out a press release saying, we're going to be announcing earnings on this date after the market close. And then it becomes a confirmed earnings date. So first of all, you have estimated earnings dates up until the time company actually confirms it. And it makes it even a little trickier that some companies don't even actually ever send out anything till maybe like the day before. But people will be going off the earnings dates, and we've used a number of sources to get earnings dates in OptionVue, NASDAQ, Yahoo. But right now we're using a company called OptionSlam.com. We started using them near the beginning of the year. They actually not only track all those estimated and confirmed earnings, but they also have an actual group of people who sits there and studies everything and manually checks every one of those earnings dates against the news, press releases, and things. So I think our earnings dates are very good in OptionVue. And I'll also show you how to checking that date makes sense by looking at the matrix. Far in advance, like a month or so, it can be difficult to tell. But once you get like within a week to 10 days before the earnings announcement, you can definitely see where the break is, where the options are not affected by the earnings date still have a low IV, and then the options that are affected by it have a much higher IV. And if the earnings date you see does not fit that pattern, and we'll look again later on in OptionVue to show you an example of it. If it doesn't fit that pattern, you know that earnings date's probably wrong. The market's probably right. And I'll also talk about the importance of before market open or after market close, because when you get an earnings date like April 28th, actually I should check that April 28th is even it's a Friday, at least it's a business day. If they announce April 28th before market open, that means if you're going to make a trade to take advantage of earnings, you need to do it the day before on April 27th, because then the next morning, by the time the stock opens, the news will already be out. If it's April 28th after the market close, you need to do the trade that day, and it's going to move at the open, which in this case would be a Monday, the next Monday. And then you can view all the past earnings dates and price charts. So let me go to the next slide. But I'm actually going to switch over to my OptionVue. Let me just check. I can't see the if anyone's writing any comments. I'm going in to look at it right now. If you write a comment, I'll answer questions. If you type them in, I'll also give you time at the end to ask any questions. But I'm only going to be checking periodically. So let's go into OptionVue. Let's go to my main page. And you'll see that there's all the different columns, including prices, and there is an earnings date column. If you don't have this earnings date column set up on your quotes display, all you need to do is click up into one of the headers that you want to add it in front of, hit the insert button, it'll put in a blank column, and then just right click and you can choose from this whole list any of those and make that column. So of course I have earnings date here, and you'll see it's blank for a lot of them, but the top of my quotes display I mostly have indexes and ETFs. So you can see a couple of stocks mixed in there. Let's keep going down, but then I do have a lot of stocks. And so here's the earnings dates on these stocks, and you can see it's always a date and then AMC for after market close or BMO for before market open. And so you can actually, in a group heading bar here, just above the date, you can right-click and it will sort by that column. So you can see here's the oldest ones. These ones were back in October. Actually, I'm in BackTrader, so let me close this. Now I'll go into real time. I'll make it a little easier and sort again. So here's Johnson & Johnson coming up on April 18th before the market opened. April 18th is a Tuesday, which means if you wanted to place a trade based on the earnings, you'd have to do it that Monday, the 17th, before the market closed. So let me open Johnson & Johnson. You can see April 18th. That means these options, which expire April 8th, and these options expire April 14th, are not affected. The earnings announcement is going to happen right here between the weekly 2 and the April. And you can see how the volatility is actually quite low on Johnson & Johnson, 9.5, 8.3, and then here it's 14. So the options that come just after the earnings announcement are going to be the ones that have the highest implied volatility. People are expecting those options to move more than the others during the life of the option. And I'll just move this out of the way. As you go farther out in time, you see it's still higher, but it slowly decreases. So you can see right now Johnson & Johnson this far in advance, these aren't really that much higher than the farther out options at about 13%. Now what you can see is we'll look at the model. And when we go into the model, this is the second button I clicked. In the very top, there's a button Volatility. And here's where you can look at the volatility. So let me just show you, oops, sorry, my slide here. Oh, I remember. I was going to go and show you. I just want to make sure I'm showing you what I told you I would. The price chart. Let's look at the price chart on Johnson & Johnson. There is a little E button here with a blue triangle, Show Earnings Announcement Dates. When you click on that, now you can go back and you'll see every earnings announcement. And we go back pretty far. Now you can see that Johnson & Johnson does not tend to move a lot, but notice right here in the last one, I'll just click right on it, they announced on January 24th, and obviously before the market opened. So you can see there was a big gap down there, big relative to Johnson & Johnson. Same thing here. As soon as they announced, it dropped quite a bit. Here it did the opposite, went up quite a bit the next day. It's this opportunity of trying to capture a big move that get people excited about trading options on earnings announcements. Unfortunately, one of the hardest ways to make money doing an earnings announcement is the simple thing to just buy a call or put. So most of the strategies that take advantage of this would be straddles or strangles, calendars, diagonal calendars. Those would be very popular. You can also do things like, again, if you're just going to bet on direction, you're better off doing something like a credit spread in the opposite direction. You expect it to go up, put on a put credit spread. And that way, because you're both buying and selling relatively close to each other, you're negating a lot of the change in volatility. We go back. I don't see any Now, how do you find things that have earnings coming up? You can simply, of course, track all these stocks like I'm doing here. But there's like 7,000 stocks. Not all of them are options. So what about coming up? We have in the tools here, there is, under here we have earnings plays, there's a search. This search is available to anyone that has OptionVue. It is not part of any of the earnings play module or anything. And what you can do is, first let me go to earnings. I have a tab called earnings that I just kind of track a few earnings. And so open this search, and you can choose how many days ahead you want to look at. So up to the next 5 business days or the next week. Then you can come down and see all these. There's 63 in the next week. Down here there's a little box. Select all option stocks. So you can see it automatically highlights all the ones that have options. Another easy way to see which ones have options is it shows the symbol, the name, the date they're going to be announcing, current price, and the DVO. And you notice that we don't track the price in DVO for, well, DVO is the dollar volume of options traded to give you an idea how liquid it is. And we don't track those, of course, if they don't have options. Then you can choose to exclude stocks priced less than a certain amount. You'll see right now I have 20 selected. If I go to $10, now there's 24 available. If I'm willing to take stocks down to $5, there's 28 available. And then I have the choice to exclude stocks that have less than how much DVO, like 100,000. 100 is 100,000. So it trades at least $100,000 in options a day. You can see there's only 7 of those. I could drop it to $50,000 a day. It's still only 8. You can see a lot of these ones that are coming up, they're very low DVO, 2, 10. If you go in, first of all, I'll just take a look. If you want to insert them into your quotes display, you just hit Insert. And it's going to insert wherever you have selected. You can also right-click on it and choose to add it to any group that's already in your quotes display. It will add all those highlighted stocks. As you can see, I'd actually already been looking at that, so that's what's above. So let's take a look at these. I have the earnings date here. And notice I also look at the DVO. Even at a relatively low DVO of 94, it's still 94,000 a day. Let me just open this matrix. And you'll see one key thing is it only has regular options. This does not trade enough options that they have weeklies on it. So the very first options that are even available are these that are expiring April 22nd. And they're announcing on April 12th. So you can't really see the, these front months are just slightly higher than the farther out months, but it's not a big difference because those are like 2 weeks out already. If you open one with more options, like a Citigroup that's coming up the next day, April 13th before the market open, it has weeklies. So now you can see they're doing it just before these weekly 2s. So you notice these weekly 1s are not involved in the earnings at all. They'll expire before they announce earnings. And they're at 18% is the at-the-money call. Where the next expiration out just after the earnings announcement is at 26. And then you see it slowly go down. Now is when I'll go in and I'll, let's see, I'll just mention this is traditionally they call earnings season when a lot of companies start announcing earnings. The traditional start of earnings season for decades was always Alcoa, which was the symbol AA. And you see that's coming up on April 24th. But recently, just this year, Alcoa split into two groups, Alcoa and Arconic, ARNC, I believe. And when they split into those two groups, they moved their earnings dates up a couple weeks, so they're no longer the first. So after all these years, AA is not the one to watch for the start of earnings season. Now the first ones really that are announcing for earnings season are the big banks. Like I always look at JP Chase. They're now kind of become the official start of earnings season, which is just a week away or so, April 13th. Let's look at JP Morgan. And here we got, again, April 13th. These options don't even have any IVs. Let's see, they're at like 20 versus 24. And now go into the model and look at the volatility. Right here, it shows at the very top, a future event date is expected April 13th, 2017. So OptionVue is automatically bringing that date in. And then it is looking, it's calculating CEVs for various periods like 30, 60, 90 days, 1 year, 2 year, and for 1, 5, and 10. And what it's doing is it's looking at this horizontal skew. And you can change this, but basically what you usually see is something along these lines. And as soon as it drops, that's the modeling that OptionVue does. And I think it's easier to see it, and you can see the whole history of it in the price chart. So now I'm going to go to a daily price chart. And here I have the little triangles. Here's what announce earnings, announce earnings, announce earnings. And I have the volatility chart superimposed. Now I can come in and choose just before the last earnings date, a couple of weeks before. And down here, there's some buttons in the volatility chart. First, you could just, the V just displays a small table that gives you the averages, the historical averages for various periods. But this M splits up the blue IV line into these 5, and then you can see the whole volatility cone, and you can see how flat it is. And now watch as we move in, so it's going a little lower, still pretty flat. This one's not having a big effect. Not seeing, like here's one of the bigger ones. JP Morgan is obviously not the best one to be doing. You should look at something that moves a lot more like Google or Amazon. And see how their options look. So it's a little more apparent with Amazon. As I'm coming up, here's kind of in the middle, the front month options. Right now, I'm 2 or 3 weeks ahead. It's pretty flat, but then you'll notice these front month options start getting higher and higher IVs, a little steeper curve there. And it keeps doing that until just before earnings. And now here's the next day after they've announced earnings. Boom, the whole line just collapses. So that's what's happening to the actual options is the vol's going down. The price of all the options in those months, both the calls and the puts, go down due to volatility. Then there's the other effect, of course, of the price change. In this case, it dropped quite a bit, so it pushed the put prices up, but the call prices would have dropped even more. Both the price and the vol crush were against the calls in this case. And the only question is, if you bought a put expected to go down, did the price move overwhelm the amount that you lost due to the vol change? Let's see where I'm at here. So I showed the earnings search. Let's just talk a little more about the modeling. Where did we get the model that we use? We actually have worked with a person, Brian Johnson. He's an OptionVue site, OptionVue.com partners. You'll see down at the bottom we have this Trader Edge. And Trader Edge is run by Brian Johnson. He's a well-known author of books on options trading. So I just went to Amazon. Here's his page. And here's the book that he wrote. We actually worked with him before he even published this book on it. It's from April 2015, Exploiting Earnings Volatility. And it's in this book that he developed this model to allow you to properly model what's going to happen to the implied volatility before and after an earnings announcement. And that's what we've incorporated into the OptionVue model. So if you want to read that, he also just came out with a new book I saw, Option Strategy, Hedging, and Risk Management, an in-depth article introducing an interactive analytical framework for hedging option strategy risk. I will say that while he's a very smart guy, his books are advanced. You have to be willing to really dig into it to understand it. So we use that Johnson model. We have the horizontal skew that I just showed you, and bringing the events into the model. And we talked about how IV slowly ramps up approaching the announcement. Now, I'll just mention one thing about that ramp up is some people swear by it and trade it, and other people claim that that's kind of illusion. What seems to typically happen is a week or so before the announcement, the market makers start saying, well, I think it's worth about $5 based on the upcoming earnings announcement. And they kind of keep it at around that price. So it's not like the price is changing. It's almost due to the time ramping up to it, but they're keeping the price the same. That causes the IV to go up. But I do know there's plenty of people who are trading that and closing the trade just before earnings are announced. Then after the announcement, there's the vol crush. That's what most people are playing, either the vol crush or the big price move afterwards. And I showed you how to look at that past horizontal skew and volatility cone in the multi-chart. And let me just go back for 1 second and look at that again, just because I also wanted to mention when you're looking at this, I should have told you, here's for each 30, 60, 90, 1 year, and 2 year, where the implied volatility is at. Then you'll see this shading. This is a 3-year volatility cone. It means that within the 3 years, here's where the IV was at. And if you slowly go back in time, you'll see like here, back in here is where it was getting really high. Oh, that's where we hit the highest part of the shaded area, right up in here. As you go down, you'll just see how the horizontal volatility skew has changed over time. And I would look at one past earnings. How about Netflix, which is on October 17th last year. Let me just look and see if I have any questions here. I see how OptionVue can help sell options to earn premium highly volatile stocks that are going to have an earnings announcement, but whose direction is not known. Well, of course, I've not done that. I'm about to show something on Netflix that moves a lot. If you don't want to choose a direction, of course, the thing to do is to go far out and do something like an iron condor. We can look at what that would look like. But here was, I'm going to turn this off and turn the vol off. I was going to look at this one, which Netflix had a huge jump up. And that was on 10/16. So I'm going to go back a little bit before that, like 10/10/16. So like the week before. Oh, it's the Monday. So this is October 10th, and Netflix is going to announce on October 17th after the market close. So open the matrix. October 17th is coming up after this one, but before this one. So this is the first, this October options with 12 days ago are the first options affected by the earnings announcement. Here, Netflix tends to move a lot, so you can see people are expecting it to move a lot. And it's 70% for this at-the-money call versus 39. Now, I'm moving ahead a day. So I'm looking at like, it's the 100 call. Oh, let me see which one. The 100 call. And it's like 527 is 71 still. So take a look at the price. It's like about $5. Of course, Netflix stock is going up or down a couple dollars. I'll just walk through day by day. Now it's at 79. It's like 4.98. Still about $5. That's 85, so it's slowly going up. You see the IV is up to almost 85, 543. Now it's the Friday before. Now it's up to 90. It's up to $6. Of course, the price has been moving some. Now we're up to the day that they're going to announce. Now those other options expired, so now this is the front month. And you'll see it's just a little over $5, but now it's up to 118% IV. And so what I did was I just said, well, let's just buy a straddle. Buy the 100 call and buy the 100 put. And what does that look like? I'll just make this slightly smaller. The very first thing you'll notice when you're analyzing earnings is OptionVue knows it's coming. Over on the far left at the bottom here, it shows expected event is modeled at T+1. So that's warning you, it's modeling an expected event. And it's saying, I think the vol is going to drop like 77.6% by this line, which it automatically goes to the T+1 line the day after the earnings are. So here's today when I'm putting this trade on, and here's what it's going to look like tomorrow after that vol crush. So what does that mean? You can see that my break-even points here it has to either drop 11% or go up 11% to make money. These little diamonds here is basically where they're pricing the straddle. So that option view automatically puts that in so you can see where they're pricing the straddle. And then there's the, I should have, I got this little thing written up here. It's what happens in this graphic analysis when it's modeling the gradual ramp up and sudden drop of IVs. It affects several features. The width of the standard deviation bar is at the bottom of the graphic analysis. The expected return and probability profit numbers in graphic analysis and Trade Finder. You can use OptionVue in Trade Finder. That's actually kind of the answer to this question. You can run Trade Finder on a number of premium selling strategies just before earnings, and it will give you the trades with the best expected return, which takes into account all of that fall crush. Now, I'm not going to go into Trade Finder a lot today, and that's because next week James Hogan is going to be doing one that's focused on using Trade Finder with earnings. It affects the standard deviation shade in the matrix, the probability of finishing the money, and probability of touching where targets can be set. But also down here at the bottom, I just want to highlight, it displays markers showing the average percentage move up and down associated with earnings announcements during the past 2 years, so the last 8 earnings announcements. That part is only included if you are subscribed to the earnings plays, I'm afraid. But it also shows the implied move for the next announcement. Everyone sees that based on the nearby options, the 2 dark blue diamonds. So that's what I'm seeing here. And here is the average move down over the last 8 earnings announcements, and here's the average move up. So you can see even though they're pricing them here, it's actually been going here. So on the upside, you're in there pretty close on the downside. So let's see what happens to this trade if I just move into the next day, because now they're announcing after the close this day. So it opens, let me go to right at the open at 8:30. The next day, Tuesday, and it went up $17. You can see where I placed those trades. It was at 100. So now this one, of course, let me show my original price. So I bought these for $5.43, these calls, and now they're worth $17.39. So they've more than tripled, like 350%. But these $5 ones I bought are worthless. Overall, though, I made money. These tripled and these went to zero, basically. So I'm up $672. Now, typically we find that most of best time to actually take this off tends to be near the end of the day, like 2 o'clock, like just after this move, first thing in the morning. Now is not the best time to take it off. Let's just look like half hour later at 9 o'clock. Now we're up $825 in the gain loss. And then from about then on, I just kind of watch it. If it ever looks like you can see it's going down a little, you start wondering, oh, should I close it? Or I don't want to sit here and lose all my money that I just made. And then you see it kind of went up to 819. So it's always a little judgment call. 829. Now I'm up to 11:30. I'm just going to skip ahead to about 2 o'clock, like an hour before the market closes. I'm up $864. So by waiting all day, I made like an extra $40 from 9 o'clock. But there was about a $200 difference between right at the open at 8:30 and 9 o'clock. Now I've seen it happen that, you know, that $200, $300, $400 could come to you by waiting until 2 o'clock. So it's always a judgment call on what you feel comfortable with. Let's see some, and about 40 minutes. Let's see if I have any other questions. And I was going to mention using Trade Finder for earnings because that will take into account for each individual stock, bringing in that stock's earnings. You don't have to run it on one stock. You could run it on a group of stocks, and it's going to properly do it. But if you're actually going to do it because you're doing an earnings date, then you should run it on a single stock. And that stock's earnings date, you know, looking just the date the next day. So now let's go back to just before Netflix announced. So you can see it's still really high. And I'll go in and I'll actually look at the Trade Finder. So you go to the Assets tab. You bring in Netflix. For targets, now notice that for targets, it already brought in this big drop of implied volatility automatically. And then let's just go to the bell curve. And I just clicked all these buttons, and you'll see this button is get the current volatility or get the modeled volatility, including event. Here's the current price. Now I can go into your strategies, and if you wanted to look at like selling, short option cover would be like a covered call. That's probably not what you're looking at. You can sell naked options, but I'm not going to do it. I'll just do, I'll select all covered, but I won't do, of course, horizontal and diagonal spreads you could think of as selling volatility because you're selling the higher front one, but buying the farther out one that's not going to move as much. I'll take out long straddle strangles. An iron condor would be that way. You would be selling both the calls and the puts, a call credit spread and a put credit spread. I'm just going to leave it, I think. I could put vertical credit spreads just to see what comes up, if anything. I'm going to get rid of all these long. So I'm just going to look at the calendar spreads, an iron condor, and vertical credit spreads. I'll give it $5,000. I'm not using any filters at all. I'll just hit go. You can see as it's running, it tells you what strategy it's working on. Horizontal debit spreads. Now it's working on diagonal debit spreads. Let's run it through this. Let me just look, see if I have any questions here. And see where I'm at in my I think you got most of it. Now I'm on iron condors. Start looking at what's coming up here. So far, there's some horizontal debit spreads. Here is a condor. We could look at what this condor looks like. Horizontal debit spreads mostly. Here's the expected returns. So let's see what this Candor looks like. I'm just going to add this trade to the matrix. Let me look at the trade field. It's saying this one. If I go into the trade log, I'll just take out this one that we just went through. And I'll just put in this. What does it look like? Looks like this. Doesn't look like it's going to do too good because of the how much it's going to move. I'll convert the trade. Oh, I already converted it. And go to the next day. See, that would not done well because in this particular case, it's all going off of the average. As I look at it down here, you can see the 1 and 2 standard deviation bars. Let me go back to the day before. So you can see these bars that it's going off of. So it's saying this expected return based on the standard deviation and where they're pricing it is a pretty good trade. As it happens, what's going to happen, and we already know, of course, because it's in the past, is it's blew way past here and came out way out here. So that's one of the problems with doing like a non-directional trade like that, is that it is it's going to give you a wide range that you're profitable in, and if you're short, it needs to stay within that range. If you're long, like you're buying a long straddle or strangle, you need to move farther than that range. And so that's a good segue into the final thing I'll just mention. Jeff just did the thing on earnings plays. Earnings plays is a module you can buy, and it tracks 5 kinds of trades. The prime movers, we call them. Those are stocks that typically make big moves, and the options tend to be undervalued, meaning you can buy an at-the-money straddle and make money most of the time. You can see it automatically, if you have the earnings module, it automatically brings it in. So here's these prime movers. Netflix is one. And you can see that says, all this is based again on the last 8 earnings. So 2 years worth of earnings. So in the last 8 earnings, you would make an average of 47%. So 8 times you put $1,000 each time, you'd make $470 profit on average, which over a 2-year period, you'd risk $8,000 and you would have made about $4,700 profit over 2 years. But that's not winning every time. 6 out of 8 times it won. And if you right-click on it, it does show you exactly what you should do. Like, to buy the straddle or strangle an hour prior to the close of 10:20. And says you can close the position any time the following day, although historically it's been profitable to hold until near the end of the day, as I had talked about earlier. Not all of them will say that, but most of them do. Most of them have been, it's better to hold till near the end of the day. One of the other ones is prime non-movers, stocks that make smaller than expected moves, and they tend to be overvalued. And here they are. You can either do a calendar or a naked straddle. Depends on, some people either can't or don't want to do naked straddles. Naked straddles tend to do better, but what you're going to do is expect it to move less. And so here's one, and it says on average it's made 27% over the last 8. 8 out of 8 won. So it doesn't make a lot every time, but so far it's won every time in the last 2 years if you place this trade. And it just tells you sell a naked straddle or strangle, near the close of 10/31. Remember, I'm looking back from last year. Although historically it's been profitable to hold until near the end of the day. Now, the next one is earnings pair, two stocks in the same industry, only one of which is announcing earnings. We call them earnings pairs. So what happens is, so here's Fortinet, and here's PANW, Palo Alto Networks. So it's going to announce on 10/27, but you buy a straddle or strangle on Palo Alto Networks on 10/27, and typically because they're in the same industry, when Fortinet announces, now Palo Alto Networks is going to move a lot too, even though it hasn't announced earnings yet. Then there's Echoes, which is two stocks in the same industry again. I don't have any right now for that. But what happens is that one's got a stock that's in the same industry that might be announcing within the next 18 days. And if they announce and the stock goes up after announcement, then you wait until the other one's getting ready to announce earnings, and you buy, say, a call or put, and just bet it's going to move the same way the next day. And the final one is runners, things that tend to run. So they've announced, and let's look at PCTC on 3/16/17. So PCTC on 3/16/17, before the market opens, so here's the day before. You'll see it's at $10.90. You don't do anything. Now it's going to announce first thing before the market open. And so when it opens, it opened down 90 cents. So let's say obviously the news wasn't that great. What you would do is, so all the news is already out and it's dropped 90 cents. You would say it's going to continue in the same direction the rest of the day. It's going to move even more. That's what these runners tend to do. And so what you would do is just buy something, like buy some of the puts. And I'll just convert it in, and then just watch it during the day. So it's down 90 cents. We'll go up to about 10 o'clock, or 10:30, see what it looks like. It's moved to $1.27, but I haven't really made any money yet. So it's still continuing to go down. How about near the end of the day, like 2 o'clock, the hour before the close? Now it's down $1.88. It moved like another 98 cents down during that same day. And it made like $570 in one day. And now here's where you close it and say, take my money and go. I guess you could wait till 2:30 if you wanted. But sometime before it closed, you definitely want to close this. See, it didn't even make a difference. Still $570 profit. So that's what a runner is. All right. And then we do have an earnings calendar, because there's a lot of trades that come in with this earnings plays that track all your earnings plays nicely. So it tells you exactly what you should do and how many trades based on what you're following. I follow a lot of them, so you can see my calendar sometimes gets pretty busy. All right. I don't see if I've gone almost a full hour. I know it's a lot to learn about with the modeling and things. One of the best things to do, of course, is do something like that earnings search each week. Kind of look at what's coming up, what's interesting, and do some modeling, track some trades, and kind of get a feel for it if you've not traded earnings before. Some people love it. It's a little too exciting for others, so just check if there's any last questions. Nope. All right, well, thank you for coming. And again, you can look for an announcement next week. We're going to be doing one. It will be James Hogan, April 11th, which is Tuesday. So Tuesday at 10 o'clock. I'll be sending out something tomorrow and Monday for anyone that wants to go see it. Of course, if you're kind of wondering what's going on, you can always go to, I don't know, if you look at our Facebook page, we have OptionVue Systems Facebook page. You can always see what's coming up there, and so you can see what we're doing. Here's Steve's Mund Market report he does every week. You can see Jeff just did that on earnings plays this last week. And what here's us. Frank Fahey did one on VIX reversals. And of course, if you were to go in, the webinar's over, but when we're done, we also have a channel on YouTube. Look at OptionVue Gym. I'll go to my channel. So you can see here's all our videos that we got on our channel. So you can see just yesterday I posted one. It's live trading of the VIX reversals with Frank Fahey. Have Jeff's with OptionVue's earnings plays. Quite a lot of things going on our thing, and I'll be posting this one here too. So you can always look at, I think if you just look up OptionVue in YouTube, you'll find our 104 videos out there. A lot of things out there about using OptionVue and just about options trading. And of course, there's always our website. Oh, not sure what's going on there. Looks like some kind of weird abstract painting. It was like multi-mirrors. All right, thanks so much for coming, and have a good day. Bye-bye.